Hi, everyone. Thank you so much for tuning in. I'm really excited to have another incredible panel for you all, leaders that I call massive leaders in lending. Many people on this call that are just across the nation, putting information out there for clients, for the community, for their teams. And I'm excited to kind of get their perspective on what's going on in the lending world and really squash some of those misconceptions about things that people are talking about when it comes to guidelines and overlays and what the market is really doing. So thank you guys so much for joining us. I'm going to have you introduce yourselves and we'll take it from there. So James, I'll start with you.
Hey guys, James Uston, Vice President with Freedom Mortgage.
All right, Steve, Elliott.
Hi guys, Steve Elliott here, Hamilton Group Funding Branch Manager. Thanks for having us.
And my other Steve, I'm going to have to call you guys by last name. So Steve Strick.
No problem. Sorry, I was on mute. I am Steve Strick. I'm an owner, area regional manager, branch development at USA Mortgage, and I'm also the CEO of the Strick Group.
Awesome. Thank you, guys. Well, we're going to get right to it. You can see I have a panel of some amazing rock stars, and we're going to go straight into kind of the very first question. You guys got hit really hard with massive influx of refi applications earlier this year, and now the coronavirus, and so many changes in the process and different products. And as an organization overall, you probably were pretty tight on employees and team members already and stretched thin, and then this happened and having to shift home. So how has it affected your organization? What have you guys really done to adapt, change, and continue to educate your team? So Steve, Elliott, I'll start with you.
Okay, great. So yeah, I mean, right before the virus hit, we were pretty busy already because rates were low. So we had a lot of refis and of course the purchases were still coming in. Then the virus hit, rates, bottomed out, and we just saw huge amounts of production coming in. So, from an organization, we've always been more of a purchase shop than a refi. I mean, obviously we'll do refis, but we love working with realtors. We love the purchase business. So, we prioritize purchase business ahead of everything else. Our refis are still going to close. It's just our purchases are going to take precedence. So, yes, it's been busy. It's been, a lot of people working from home and putting in extra hours, on weekends and overtime, things like that. But we've been getting through it, and so far so good. Our purchases haven't lagged longer than the 30 days that it would normally take, if not sooner. So everything's so far so good with us.
Yeah, and you have if I'm not mistaken, the majority of your underwriting and everything is in South Florida with you, right? And they've all pretty well been able to shift to work from home very easily.
Yep. Our technology department was great, just getting everybody set up, all departments throughout the organization. It's kind of crazy how overnight everything just changed, but it's business as usual. And with all the technology, we really haven't missed a beat. I mean, it's been going real well.
Awesome. Thanks, Steve. So my other Steve, you manage a big organization, all the way across the nation from, you said San Diego to Florida, right? Kind of. What does that look like for you overall, and how did you guys shift as a company?
Yeah, it's it's a great question because nobody was prepared for an influx of 60% additional business. It's similar to a real estate agent, somebody that's used to doing 3 deals a month, and then all of a sudden on Monday morning, 30 contracts get dropped on their desk. So that's kind of how I'm trying to relate this, to our real estate partners. Along with Steve, we're purchase driven. Purchase business is the lifeline of our business. So we were ramping up for our spring season. We're in all across the country, but where I'm at locally, where our corporate office is a little seasonal. So we were hiring at that time. And not only that, but we always operate with bench. When I say a bench, there are resumes. There are plenty of people that we interview all the time that we're ready to pull the trigger on. Luckily, like Steve said earlier as well, I think we're going to have a lot of redundancy, but our technology, our marketing has been able to keep everybody educated and in front of the process. So we haven't really skipped much either. We closed about 1,500 loans last month for a little over 320 million. So in April is just much larger, but we've had to shift completely to virtual. So we have roughly 700 employees, and taking 700 employees and turning them into about 95% virtual, you would not imagine how well it went. But it's all about the company helping each other out, people putting in extra hours, the overtime. While I say that our salespeople are doing a great job, I think that a lot of these deals were easy. We really need to tout the operations on the back end. It's the processors, the underwriters, and the lock desk. With all these changes going on, I give huge props to our lock desk. They've been ahead of everything, and it's been great. So we've been staying ahead of it, and I think that we're going to be doing just fine throughout the process. And as long as we keep our real estate partners and referral partners educated on what's happening on our side of the business, it sets expectations. So while there might be a delay, it might be a delay because of appraisal or title or a mortgage company. Listen, we fall on the side, but at the end of the day, we all work in this ecosystem together. So it's all about support too, because you're going to see frustration. You're going to see people get tired and worn out, and they might get snippy, but at the end of the day, I'm here cheering my people on to say, guys, we're in this together right now. Hold your frustration, hold your stress. If you get stressed out, get away from the computer, get away from the phone, take a lap, come back, because when this is over, we're still a team. So yeah. I hope that answers your question in a long-winded way.
Definitely. And I can feel you from, the operations just really being the heartbeat of the organization, and their ability to adapt, even in my organization, has been incredible. So that's so good to hear. James, from your end, you run an organization that's across multiple states with, hundreds of employees, and specifically being in New York, that's where you are now, right? How has things changed for you, and how different does it even look up there? Can you hear us? You might have frozen. I think he froze. We might go on to the next question. James, can you hear us at all? No? Okay. All right, guys, we're just going to pop into the next question. We'll jump back to James on that one. But, with the rates being so volatile right now, and, the market just being different, are there any conversations? Are the conversations different with your buyers now? And, I'm sure you're hearing it every single day, like, is now even a good time to buy? So let's jump into you, Steve, with that one.
Me?
Steve
I'm
Elliott.
sorry, man. I blacked out. I don't know if you guys could still see me.
No,
I apologize.
No, we'll jump
it was
back
happening when I was signing in as well. You want to jump into his question and then come back to me? I'm sorry if I cut you off.
I'll jump to you. He hadn't even started yet. So thanks. This is,
Great.
Of course, with technology, right?
Yeah, unfortunately.
To you, I don't know if you heard, me talking specifically about you and your organization, majority being out of New York, and how are you guys dealing with the coronavirus, with it being so much more severe there as well, and managing across the different states?
Well, I think that we just had to address it earlier than your side got hit a little bit later, and you guys are probably seeing a 2 to 3 week lag to how the severity. And although cases are paramount here compared, we're dealing with a lot from a national standpoint, as I'm sure we all have. We just got hit a little bit earlier, but luckily, staffed to some degree to begin with, right? We're coming into purchase season, and because Florida is a little bit different than New York, we run more specific to end of school seasons, when weather gets nicer. So we were kind of prepping for that. From a staff also, and I know, still see me? I keep getting blacked in and out. I'm sorry.
That's okay.
We were already staffed for an increase in production. However, to Steve's point, no matter how prepared you are, you can't be prepared for the influx that all of us got handed. We are identifying the purchase business first and foremost, and we want to keep our relationship alive. And we understand that the real estate professional title companies and associated with, these wheels need to continue to turn. We are today also receiving a heavy influx, more than ever, of refinances where we weren't built, at least my group, with. And we are the home team. We represent the largest retail piece across the country. So we got hit with a lot of refinances, and I have to give kudos, the same way Steve did, to the operational staff, because they really rolled up their sleeves. We were remote before most of the country. I have hubs in Indiana, in New York, in Jacksonville. So we're spread out and started to hit, location to location, and everybody went remote. Everybody did a fantastic job working overtime, working weekends, putting the extra time in, and that all hands on deck type of mentality. So it kind of shows when times are tough, the strength of an organization when you can. And we had our best month ever in terms of funding transactions last month. So it's a testament to that hard work. I would like to see the purchases starting to come back into the level that they were. But first and foremost, we want everybody to, I think we'll be prepared for when that inevitability comes back. Just unfortunately, we're only speculating, all of us. We just don't know, right? So as a lot of realtors that are tuning and watching this, we're here to help. We are trying to give education about some unique ways that you can still stay in front of your referral network and show value through all of this. So I'm echoing a lot of similar points. We're in that similar type of position, but I'm proud of my group and my organization for what we've done thus far. And we're going to continue to put that hard work in to make sure that we carry these deals through, right? Because there's an existing pipeline for all of us of purchase business that for one reason or another, loss of employment, being concerned, being scared, not being able to do appraisals, not being able to do certain searches, or are you allowing a virtual closing? So all of those layers have kind of put some hold in that pattern of closing. And an important thing for us to stay ahead of it and our referral partners is identified, and I'm sure we'll get into this, guideline changes, right? Because these deals that are in play are going to be affected.
Yeah.
To what severity? Each deal is so unique, right? It's not one deal is the same and one deal equals all, right? So we took a proactive approach, which I like to say all the time. Much better off being proactive to reactive, to look at the existing transactions and say, hey, this may be affected because this. Rip the Band-Aid off, get in front of it with the consumer, keep the referral partners in line with what's going on, and then ultimately get it to the finish line. Now, the $1 million question is, when's the finish line, right? And I'm hoping one of you could fill me in on that.
I know, I would love to be enlightened as well, but I think I all three of you agree with the fact that the way that you've handled your organizations, and the way that they've shifted has been amazing. And you've had some of your biggest months ever, and that's something that just shows a tribute to your leadership. So that's amazing. But yeah, we're going to jump into some guideline questions, like you said, here shortly. But the next one, just as I was speaking before, just about the rates, constantly changing. And you were just saying it, James. Sometimes those conversations are a lot different now with your buyers. There used to be 10 minutes, and now they're 45 minutes. There's so much uncertainty. So what are those conversations like with your buyers now? Around even a good time to buy? What do the rates look like? Or does the rate question even anymore? Is that the number one priority? So I'll start with you, Steve Elliott.
So yeah, obviously with all the news and everything that's been going on, consumers are aware that rates are low. We had a little bit of a situation, because of the increase in production and a bunch of behind the scenes things that rates kind of spiked just a little bit, but we're back to being in the low threes. They always want to know if it's going to go lower. And, when you're quoting someone 3% flat, and they're asking for more, it's kind of funny, but we don't know what's going to happen. They say rates could drop a little bit more, but we don't know that. So way too much uncertainty, a lot of uncharted waters. I'm advising my purchases to lock. We don't want to get caught in a situation where we quote 3 and then we have to give them something higher. So we are locking those. The refis we're being a little more patient with. There's certain numbers that borrowers want to reach, so I'm kind of watching those. So it's a case by case situation. But yeah, they know rates are low, and they all want 0%. Like the Fed lowered the rate to, I couldn't tell you how many text messages and phone calls I got saying I want 0% now that the rates are at 0. So we just got to keep them educated, keep our referral partners educated, and just be honest and upfront with everybody.
Yeah. So when you get the question, is now a good time to buy? What does that conversation look like now with your buyers?
Yeah, I mean, to me, absolutely. I'm very bullish on the housing market. Obviously, it's tough times right now, and like James said, we don't know how long it's going to be. But if you're a buyer now, especially a low down payment borrower or maybe a Govy borrower, the competition's not going to be there that it was maybe a month ago or 2 months ago. So especially down here in South Florida, we might get 5 to 10 contracts on a single property, where now because of the virus, people are staying home. They might have their pickings of listings. And, a lot of agents have reached out as well and said, should I be listing these properties? Absolutely. Why not? There are still buyers out there. Again, we're in South Florida. There's always people coming and going. So, list those properties. Obviously take precautions in terms of the mask and things like that, but hand sanitizer at the door. But yeah, I think now is a great time to buy. Rates are low. I think now is a great time to sell. I think you can get a good buyer. We just got to be careful with all the mortgage guidelines and all that fun stuff, but we'll definitely get through it.
Okay, awesome. And Steve, my other Steve.
Yes. We've got some great minds on the call. So a lot of these things that we're doing, I think these are best practices. As far as I always tell clients this, the market is always right. It's never wrong. The market is always right. What does that mean? It means to those clients that say, hey, you know what? I think it's going to go lower. Hey, you know what? It might go lower, but it might not. So I'm not in the business of predicting the market. If I was, I'd be in a different place right now. But, it's so volatile that if you're comfortable with the payment, if you're comfortable with that rate, take it. Take the deal that day, because you can always refinance later if the deal, drops from 3% to 2.5%, right? So why miss this window when it could go up to 3.5% tomorrow? Because that's what's been happening. It's really unpredictable. So the refinance market, I think it's a great opportunity. It also can eliminate that F word, which is forbearance. We can get into that in a little while, but when you structure a refinance, you can kind of help people skip a couple payments maybe, and save money along the way. So there's a lot of different ways to get creative with this stuff. As far as buying a home, I'm not in sales mode right now. I'm in a how are you doing mode. And, that's a thing that we've been seeing across the country because people really care about people at this point. And I'm more interested to see how you're doing because real estate and mortgage, that will come further along in the conversation. Now, once you're talking about purchases, then you got to talk about are people's jobs safe? Because verification of employment is getting much more strict. I'm sorry. They're wanting verification of employment now within 2 days of closing. And they're also doing VOE within the 3-day rescission period on a refinance. So, us as lenders, we don't want to pay that stuff back, if we're not doing servicing. So there's a lot of things going on in our world right now to where I don't know if there is a right or wrong answer. But if you can find the home that you're comfortable with, and if you've got the confidence in your employment and you think things are going to be okay, rates are great. Go ahead and buy. Because I don't know if the market is going to go up or down. There's mixed feelings about that. We own a real estate company also in St. Louis, a large independent. And, that's a question that gets asked to my wife and her agents all the time. Well, their value is going to drop. Should I hold off? We're not really sure. So rates are low. Values are decent. I'd say if you're comfortable right now, do the deal. If you're not, maybe wait it out a little while. But I can't tell you what's going to happen in a month. I can't even tell you what's really going to happen tomorrow.
Yeah, thanks for that, Steve. And from your perspective, James, too, it sounds like, you said earlier, conversations are different with your agents and you're bringing more value outside of just talking about the transaction. What do the conversations look like when it comes to rates?
Well, rates back to the general public or rates back to trying to explain it to the real estate community, right? Because it's two different conversations. Now, there's a lot of misconception with the way interest rates even work. Then there is institution to institution risk. What's my appetite versus what Steve Elliott's or Steve's? So all of this factors into the end result that the institution is going to be offering what could be the same borrower. On a given day, yesterday, all three of us could have been sent the same client. We could have been pricing all of those loans on a regular day differently, but it's heightened now, right? And to Steve, I'm sorry, I'll say Steve and Steve E, just so you know who I'm referencing. But to Steve's point about the lock desk, capital markets, what they're dealing with and how that's translating. I mean, there were times when we saw the severe drop, right, which caused that initial refinance boom amidst all of this chaos and tragedy happening around us. Now, when that started to happen, I could literally quote an interest rate right now. And by the time I take an application from that client and try to pull the trigger on a lock, I'm out of market, and I'm out of market substantially. So I've been doing this for just about 2 decades, and I went through what I like to call the good, the bad, and the ugly in this industry, right? And I've seen times where it was, volatility, but nothing to this degree. So it's hard to give the layman or the general public a full understanding to all the intricacies and moving parts behind the scenes, right? To what that end result is. And look, it used to just be, hey, look at the 10-year treasury bond. If you follow the 10-year, that's what we're looking at. Now, I can't say that the 10-year is following rates because it isn't, because you have MBS behind the scenes. Is the government coming in? Are they putting billions of bond buying power behind a given day? Are they going to expand it? Are they going to pull it back? And the reason I'm getting into this is because I really want to show the complexity that the mortgage person has to deal with in providing what we want to feel is the best execution. Now, past the volatility in these crazy times, let's look back to a normal time. And back to another point that Steve made. Your rate is given on when you decided to buy or refi at the end of the day, right? Mm-hmm. So where rates are 3 months from now, it's all speculation. My opinion, and I'm not going to go further than that, is that we're going to see a substantial shift into a buyer's market. I think that uncertainty causes fear. And I think that when people are afraid, they don't know what's going to happen, they're going to be reluctant to make big decisions like selling or buying. Now, if their given industry wasn't affected, maybe not. But to your point, the layers of this, we're going to continue to see an effect. As bad as everything that's happening from a tragedy standpoint, and that all of these people are getting sick, and I'm sure we all have someone that we're close to, there's going to be a much further ripple effect past health and human safety, because the economical adjustment that's going to happen. I mean, it's funny. I was driving down a local block. I had to go drop something off at a family member's home, and I was driving from Brooklyn through Staten Island. And a normal area, which is very, very busy with restaurants and people eating, all these restaurants are shut down, right? I know a couple of people that own restaurants. They can't keep the restaurant open because they're not getting enough orders to pay the staff. So it's actually like opening is hurting them even more. Mm-hmm. Then they're having to make decisions. So the reason I'm bringing this one point up is this is just a restaurant. When you start layering this out, I mean, there's going to be a much further effect to not just our business, but the overall economy. Now, I don't want to be doom and gloom because, to my same point, 20 years in, going through multiple recessions, seeing what the inevitability is, we're coming back. And I'm sure, given the government that we have and who we are as an industry, we're going to come back better than ever. It's just how long is it going to take? And have you put enough nuts for the winter away,
I love that. And such a powerful message, just touching on the different layers that are involved, and of course the different things that you guys have to deal with, especially like Steve E talked about earlier. I know when they announced about the rates dropping to 0% and people jumping all over that, a lot of times people don't understand the complexity of the mortgage market. So I love everything you touched on, James. So that's super important. So just kind of heading into what you were talking about before, and one big thing about that everyone's talking about is guidelines and overlays and how things are changing, and the misconception that it's a rule overall, and sometimes it's very lender specific. If we can kind of just give me a general rundown of, from your organization, what things have been put in place, if any guidelines or overlays have changed, and how are you really communicating and staying in front of the public to let them know about that? Because if I'm not mistaken, it does happen mid loan application, right? So that's something that can definitely affect people. So I'll actually go ahead and start with you, James. We'll mix it up a little bit.
Reversing it. So I think this is a very loaded question because each institution is different, right? So we're talking about someone who is a depository institution, someone who is portfolio lending, or could it be a correspondent lender? Is it just we're lending just based on Fannie, Freddie, and Ginnie? Are we direct? Are we correspondent? So all of these factors are going to change the responses to what's happening and how much each individual institution is affected. I can only speak on behalf of my institution because of the size and the many moving parts. Luckily, we've been very good with what the agencies have put out in terms of additional overlays, right? So over the weekend, you saw big names out there saying that they don't want to take any deal with any FICO score below a 700, nor any purchases with less than 20% down. You're talking about one of the top 5 players in the lending space in the country taking an aggressive stance because they're not willing to take on the risk, right? So what that does is it opens up for some people that are playing in a little bit smaller of a pool to say, hey, I'll be more aggressive. But then that aggressiveness comes at a price, right? So what happens? We're dealing with it well. Do I have very similar overlays? So what I'm sure the other gentlemen are going to put in play, and I won't steal all the thunder, self-employed borrowers losing percentages of what we can qualify. Are they deemed essential? Do they now have to show 6 or 12 months reserves, whereas maybe they would only show 2? Then you have people that are, unfortunately losing overtime, even if they are considered essential. Or are they getting more overtime, which is not typical? We used to be able to get a pay stub within 120 days. Now we need a pay stub within 60. The verification of employment. Listen, even if someone's essential, try to get in touch with an HR department, right? Try to get something in writing. So yes, there is our overlays, but we are adhering to what the agencies have put forth, meaning I can still write a 620 FICO score on a conventional loan. Some lenders are 640, 680, or up to 700, like I just said. Then you have FHA, whereas there was a time where I was Ginnie direct and I can go down to a 500 FICO, where a lot of institutions wouldn't look at that paper. Now, that's a common sense underwriting approach and a more in-depth investigation as to why the FICO was so low. I'll leave that off to the side. That same program where I would have needed to put 10% down now has popped to a 640, right? So what does that do? It shrinks the pool of buyers. It shrinks the availability of credit. So there's less consumers able to qualify. Again, I think this is going to be a temporary restriction, assuming we see the light at the end of the tunnel. But today, this is what we're working with. And the likelihood that you're going to see additional overlays is extremely high. So to your point, I think it was Stevie that said it, this is bird in hand time. If you have a deal, you have a job, you're healthy, you're safe, you want to move forward with your transaction, and you have the ability to close. Because leaving this as speculation, you're gonna deal with a lot more fallout as this goes on. So.
Very good points. Thank you so much for those details on that. And Steve, Elliott, I'll let you touch on it. And if I'm not mistaken, you guys are generally a direct lender, and this is something James was touching on. Kind of tell us the difference between that and how you're kind of balancing the different guideline and overlay changes as well.
Yeah, so James was pretty much spot on. I mean, everybody's feeling it different, but in the same way as well. A lot more restrictions. Investors are going to cherry pick right now. There's a lot of new deals coming in and their pipelines are full. And when they get too busy, they can kind of, pick and choose which products and which kind of loans that they want. So, we did see a little bit of tightening of credit. I do feel like James said that it will come back at some point. We just don't know when. But right now they are cherry picking. I feel like they're looking for the best of the best. Lock the loans, like we said earlier, and we'll say it again, if you're locked in and you're underwritten, there's a lot less risk there than if you're not. So purchase business, get it locked in. That way, if something changes, hopefully your organization will honor that lock and honor the underwrite. So same, pretty much the same stuff.
Yeah, perfect. And from your end, Steve?
These guys are good. They know what they're talking about. It's one of those things where James said it, each institution is different. So we're correspondent and we lend direct as well. So, I mean, we do go off the agency guidelines, but we've got meetings every day, and it's the layers of the guidelines. So furloughed income, like we just had a call yesterday. We're not accepting that anymore. We had a call, what was it, a week or two ago, where it was one of those deals where, FHA was getting priced out of the market, and we decided to go ahead and keep under 620 open, just to do some of these deals that other people weren't going to do. And it might have cost some points, but I remember in one of the markets in Ohio, one of the branch managers said, look, we had a deal and it was 5 points off pricing. And everybody else was like, get rid of it, forget about it, we're not going to do those. And he said, no, the seller gave us the 5 points. So you negotiate that with the seller on how to get those points for your buyer. These are all conversations that you're having up front with your agents to educate them on how to get these tougher deals done. So, the appetite is getting different. We just had something go out today where the stimulus income can be used as down payment. These tips are coming out every single day, and we just got to be nimble. We got to stay educated. And I think that, of course, there's a flight to quality. One of our coach says, there's a, what do they say? They follow the money. So follow the money says, what are the big players doing? James saw the same thing that I saw. I even posted on Facebook, one of the largest institutions, number 4 in the country, went to 700 credit score plus, 20% down plus. I think there are going to be some other people follow suit. But I also think there's going to be people trying to clean up the back end and get some of that opportunity and take that risk. So they're not going to be as many. There's going to be some. And it might work for them, it might not. That's not for me to predict. But I do think that there's going to be people lending on both sides of that, 700 score. So it's temporary. We got to deal with it while we deal with it. I think that we're going to come back strong. It'll be a comeback that's going to be industry specific. But again, we're blessed and fortunate to be in the business we're in. As long as we stay ahead of it and educate people, then, the housing market itself will be strong.
Absolutely. So it's a daily thing, and same on Thailand, right? We're trying to keep up with everything that's changing. And we just had a question. One of the comments is, are deals still closing? And they are. We are very fortunate that they're still closing, and most of them still pretty seamless and with care and diligence, but they are still closing. And with people like us who are staying educated and staying on top of the market, I mean, how could they not close? So that's great information. Thank you guys for that. And Steve, I'll let you kind of start this one again, but you were just touching on it before, but talking about the resource constraints and the things that are happening when somebody is under contract right now. I've heard of like drive-by appraisals and different things that people are doing to allow for waivers, whether or not they can get a hold of somebody in HR. Are there any specifics that you all have put into place that are allowing it to be an easier transition for people that are under contract during this time?
Yeah, it's we got some information from a big player. He's a friend of ours up in Boston, and he put this Facebook Live thing out, and he said, and this was when the refinance boom happened. So the refinance boom happened, and he said to all the agents out there, the real estate ecosystem is being affected by the refinance boom. So here's what we have to do, guys. And this is coming from, a high-level broker owner. He said, let's be patient with our mortgage people. We got to be patient with our appraisers. We got to be patient with our title companies, and so that way, what you're doing with all of that is educating the buyers, that the buyers and sellers, that the mortgage business, there might be a little bit of cog in the wheel because of all this business that came in. So what are we doing? We might be extending closings to 45 days instead of 30, or 60 days instead of 45. That's market specific. In California, we close pretty much everything in 30 days. This has not changed anything, but in other markets, we're pushing that back a little bit. So again, it's just setting the expectations. And we're following the guidelines. So as far as appraisals are concerned, certain programs do allow the drive-by appraisals. We're accepting that. You're looking at property inspection waivers for refinances. There's a lot of different things that happen within our industry, within each sector of it. So I'm just saying we're being flexible and we're trying to follow what the agencies are doing. That way we have an ability to sell our loans.
I love it. Flexibility, right? And that's a big word, right? Patience. We're definitely seeing more of the extended closing dates as well, more like the 45 days, on the title end. And just being flexible is super important with buyers. So it's good to know that you guys are doing that. Steve, Elliott, from your end, anything that you guys are doing as far as waivers go or appraisals or additional time for underwriting?
Yeah, same thing that Steve said. We're going to go off of DU and LP when it comes to the waivers. As an organization, we're closing loans without getting the 4506 back. Little things like that just to help kind of everything go through the process in a timely manner. But yeah, we need people to be patient. This is when relationships really come out. This is when you really trust your referral partners and they trust you. Just to make sure that you're doing the right thing and moving the deal along. But yeah, it's an ever-changing environment, and we're staying on our toes with it as it happens. It's that we're just rolling with the punches at this point.
Definitely, yeah. Relationships and communication is everything right now. So, James, from your end, anything that you're seeing, and I know, dealing in New York is probably a totally different beast. So that's daily changing when it comes to having to be flexible. So what does it look like for you guys there as well?
So from an appraisal standpoint, obviously people are reluctant, number one, for an appraiser and their safety to do the inspection. Number two, for the homeowner to allow access to do the inspection. In certain cases, we just cannot avoid it. And to both Steve's points, it depends on the transaction, right? A rate and term refinance, I may be able to do a drive-by appraisal or get a waiver. For a cash out refinance, maybe they'll want me to do a desktop appraisal. Right. So it just depends on the transaction. So it's unfortunately not one size fits all. And I know a lot of the real estate community, even general public, would like a clear cut answer. But each deal is different. As I mentioned before, we're taking every measure and we're understanding. Listen, we're people first, right? We understand just the complexity of life right now. Forget about doing a mortgage or selling a house or getting a listing. We have to be people first and be understanding of that. And in everything we're doing, that's first. But past that, if there's willingness and people are able and healthy, then we're taking the correct measures. We're doing the inspections, we're scheduling the closings, and so forth.
Awesome.
Is there a question outside of appraisals? I might have missed it, cut out for a second when you were asking.
No, that's okay. Outside of appraisals, is there anything else when it comes to, verification of employment or any other things throughout the loan transaction that maybe you guys are being a little bit more flexible with to help your borrowers?
Yes, we're understanding to a given situation, but we do have to follow the agency guidelines, right? Or whatever overlays have put in play. So yes, we're understanding. We're willing to go that extra step. We're contacting people on Zooms and people who don't have scanners and taking pictures, and we're being as creative as possible within the guidelines. And again, we're understanding. Listen, it's tough for all of us, and we're making any concession when it's available and allowable.
Yeah, I love that. And just, we're in a different time, like you said, being creative. I never thought that people would pull up to a title company and do a closing in their car, but we're at those times right now. We're like, let's just make it happen and get it done. So I love that you guys are just completely thinking outside of the box. And going into that too, watching the news is a terrible thing right now, and they're talking about the housing crisis and getting people very fearful that we're going to see a replay. 2009 and all of that. But, what can you guys touch on? And I know, Steve, Elliott, you kind of manage your company through that time as well. And it sounds like James and the other Steve as well. But, what do you feel like, how is this going to shape the mortgages where we're not going to see another housing crisis like we did before, and to really make people not be fearful that is happening?
I think we got to start with the F word that was mentioned earlier, the forbearance thing that's been going around. So that that could be a big problem. That's a behind the scenes factor that I don't think the general public is really understanding. Obviously, if you lost a job and you can't pay your mortgage, you don't have the savings, then yes, take advantage. That's who the program is for. But for everybody else who just wants to skip a few payments and just take advantage of the system, there's a huge crippling effect behind the scenes that could happen. And we just need to really, be out there, let everybody know that if you have the money, pay your mortgage. That's kind of always been my motto, even before this. If you got to pay your mortgage. There could be a lot of ramifications. It's not free money. You're going to have to pay it back. And sometimes it's in lump sums. And then who knows the effect that it will have on a borrower moving forward. Lenders might say, if you did take advantage of it, now that we're not going to refinance you, or you have to wait 12 months before you buy again. So there's just a lot of uncertainty and a lot of misconceptions. That forbearance thing is going to be huge. In terms of housing crash of 08, like 08, I think it's different times. 08 was monopoly money. People weren't qualifying the way that they are now. We're verifying everything. We're making sure people have jobs, income, assets, equity in homes right now is at an all-time high. So can the market drop a little? Yes. Could it flatten out? Absolutely. Are we going to see a crash like 08? Nobody really knows, but I don't see it happen. And I think people, unless obviously they lose their jobs and things like that, the ripple effect that could happen from the virus. But, there's a lot of uncertainty, but I think we're going to come through it. We just need some good news out of the virus and hopefully get past it. And then hopefully it's business as usual after that.
Definitely. Thanks for that, Steve. James, from your perspective on that?
All right. A lot of the signs are kind of there that we could go down that same type of path. But Steve made a very good point, right? The qualification leading up to 2008 was a totally different. There was a totally different market out there. You had stated income. You had no doc. I mean, you could say that you were a teacher that has an average salary range of 80 to 100,000, making 300,000, and they weren't verifying, right? So that, accompanied by the fact that people were using their homes as ATM and just constantly refinancing and not thinking about the adjustable rate and when it was going to come due. So that factor is different. But where I see similarities, unfortunately, is really depending on how long this goes and how much the government steps in to be able to quell the needs of the market, right? And when I say the market, it's not just the stock market. It's financial institutions like my institution, like our institutions, like our industry. There's privatized money involved here that if the government doesn't step in because an institution isn't FDIC insured, it's causing more of these ripples to happen. And listen, housing will always be our biggest economic, domestic, the biggest part of our economy, right? Every house that's sold brings how many jobs, brings how much money to a community, how many people are involved in the transaction. So the focus, in my opinion, on a governmental level should really be to prevent this from happening. Now, if they do or they don't, I can't answer that. And the timeline that this goes for, I mean, if God willing, we're back to normal, let's say by the middle of the summer. There's antibodies, there's a cure, there's, you can't get it twice. Whatever comes out of this sickness and we're back to normal, the shorter period it takes for us to get there, I feel is going to determine the longer it takes for us to rebound, right? So if we go 2 months, it may take us 6 months, 8 months to get back to normal. But if this goes into 2021, I have a fear, and this is only opinion, if that goes that long, that we're going to see a major hit to all those key points that Steve brought up. Property value, right? We're still at an all-time high. These remain stagnant. It switches to a buyer's market. People are offering less. Now the mentality from the general public, when you don't have it and you're stressing about how you're going to pay your bill, and they know that these bailouts have happened in the past, what's going to happen? People are going to stop paying the mortgages, right? Depending on what state you're in, what your foreclosure laws are. There's just so many little pieces to it. It's an impossibility for myself, in my opinion, or anybody on the call to give that stamp. But from an opinion standpoint, the longer this goes, the more likelihood we have to go into a deep recession. And the reality is, guys, we've had a really good run. We're overdue. These things are cyclical. They happen every certain amount of years historically. We were overdue for a correction in the market. And this isn't doom and gloom, and I'm all for the positivity, and I'm hoping that none of this happens. But unfortunately, sometimes you have to watch the writing on the wall, even if you're not ready to read it yet.
Yeah, definitely. So I think, giving that sense of reality as well, that, there is the potential. We're all hopeful, right? We all want to have that foundation of hope, but there has to be some reality in it too. So, Steve, from your perspective, what do you really see?
Yeah, following up third, it's, I could hit on all the points that they said, and I agree with, I'd say 95% of them. I really do. 2000, when people ask about 2009 and today, again, 2009 was a credit crisis. This is a health crisis. So can it turn into the credit crisis it was? No, because those fundamentals have been changed. So everything is verified, and we're not lending to people that shouldn't have been lent money. And, so I think that that's really important that we distinguish the difference there. I also believe that James is right. It's an unemployment thing. It's a government participation thing. It's how long does it take before the economy is opened up again? I have a lot of different views. I think that the government has done a pretty decent job so far in stepping in and taking some measures. I hope that they continue to do that, because we're going to need more. And where that more goes to, I'm not exactly sure. Steve E. touched on the forbearance thing again that I brought up earlier. That has potential to be a major issue. It really does. Without getting into the details, those are things that us as lending institutions have to be careful of and wary of, and have those conversations with our borrowers up front, because the institutions that don't take the forbearance thing seriously, they're going to get crippled. They really will. So again, back to the point, I don't think the two times are relatable and why they happened. Could the effect be similar? I think it could be similar. I definitely don't think it could happen to the degree that happened. And the reason being is another thing that Stevie said is we've got some equity in our homes. There was not equity in those houses back then. So if we see a little bit of a housing drop, we've got some room for it to not be as bad as it was in 2009. So fingers crossed that the government and all the smart brains get together and say, hey, we need to keep alive the housing market, because like James said, it's the number one driver of our economy. So I'm hoping that everybody steps in, does their part, and we can kind of get through this together. So far, so good.
Yeah, definitely. Thank you for that, Steve. And Steve, Elliott, I want you to kind of, you were mentioning it before, but one of the questions I do have, and that many people have, is this F word, right? Forbearance. And it is, talking about delaying payments, and like James said, it could have so much of a bigger effect if, people are doing it that don't necessarily need to do it or have to do it. And as you mentioned, there's much more cost in it. It's not just the payments being tacked on somewhere else. There's additional costs with amortization and everything else. So can you kind of give us an idea of what forbearance looks like, and are there any other options for homeowners?
Yeah, absolutely. And I posted on my my Facebook page today a great video that another lender did that just very simply explains forbearance and how what it could have, the effect on the economy and the market behind the scenes. The program is a must, right? For when people lose their jobs and they lose their income, there's certain people that have to have it. So I'm not totally against the program. Obviously, I think there just needs to be parameters as to proof of hardship. I think the MBS, and they're working with the government and to try to go ahead and implement those so that it won't have where just everybody takes advantage of this program. So I think that would help a lot. They're nothing is free in life. You're gonna pay the money back, whether you pay it back. If they give you 3 months off and then on the 4th month, you have to pay it all back at that point. Or if you're going to pay it on the back end of the mortgage, it's going to be repaid. So I just tell everybody, you know, if you have the money, you have the savings, you have the means, pay your mortgage, pay your mortgage, pay your mortgage.
Anything James or Steve you want to add on that?
I'm gonna echo that point. You know, if you have the ability to pay. You know, contact your servicer, ask what options are available for your specific situation. Because look, you might get some time off, and to his point, they may ask you to come up with the 3 months right away to reinstate. They may push it to the back, and there has been some interpretation around this from different servicers with how each one is going to handle it. But you know, outside of that, listen, each individual person's situation is unique. The servicers do want to help. If you're hurt, contact and go through the process. But I think that you should look at this if you legitimately need help. And if you don't, leave it for the people that actually do.
Yeah. Perfect. Anything from your perspective, Steve, on that one?
Yeah, I mean, I think that it's a necessary tool that we may need. I agree with these guys too. If you can make your mortgage payment, make your mortgage payment, because James said, you know, the word interpretation. Interpretation is completely different than the specifics. So each servicer is going to have their own specifics within this forbearance. And you can't talk to your neighbor and say, hey, man, you know what? I just got my loan forbearance for 120 days. You should do it too. Well, guess what? He might be with, you know, servicer A. This guy's with investor B. And those are two totally different programs. So I agree. If you can make your payment, make your payment. If you do have to go into forbearance, maybe talk to a mortgage advisor that you trust and say, hey, you know what, man, I'm thinking about doing this. Can you shed any light on this for me? And then 3, make sure you have the details ironed out. Make sure they're specifically told to you, explained to you, because you need to know what you're getting into. The last thing you want to do is go into a program that's going to hurt you first later on.
Definitely. All right, guys. Well, this has been such good information so far, and we're just going to wrap it up with just kind of one last question. If you could really, you know, leave your realtor partners and referral clients with one thing to do or one resource to follow, whether it be a blog or anyone that has really great information about the mortgage and buying process to totally stay informed, or any other words of advice, what would that be? And I'll start with you, Steve Strick.
I'd say call Steve, Elliott, and James. No, I'm joking. No, really, it's more important now than ever. We had a call with our real estate company this morning, and you know, I was just bringing them up to speed on some things, and their mind was blown. You know, so we've got to be experts and advisors in our field, because we're going to be the ones helping our real estate partners and referral partners hold these deals together. And the more that you can do that now, the more they're going to appreciate you later on. And I'm just saying, you know, we got to work twice as hard, not 25%, 50%, or 100% as we did 2 months ago. We got to be working twice as hard to stay ahead of this for you guys.
Definitely. Steve Elliott.
In terms of blogs and people to follow, Barry Habib has been great on MBS Highway. He posts things throughout the day, morning update every day. I mean, so informative, breaks it down as to what's going on. So anybody in the industry, you know, should really be listening to him. He's really got a finger on the pulse of the market. Advice to realtors, you know, take this time not only, you know, to spend with your family and figure out what's important, but take this time to figure out a game plan, how we're going to get through it, how we're going to bounce back from it, how we're going to market after this. Call your database, call every single person. And like Steve said earlier, don't try to sell anything. Ask them how they're doing. How's your family? Just have a conversation. We're all human, and this is the best time to be human. If they want to talk business, we talk business, but just reaching out to your database, asking them how they're doing, and we're going to all get through this together. It's definitely going to be some tough times, but we will prevail.
Sure. James?
So without question, right, we want everybody to be safe and healthy first and foremost. And, you know, from your individual families to the people that you're maybe contacting within your network, whether you're staying in front of them via social media, what we have tried to do outside of our personal lives from an organizational standpoint is bring some value to the current events of what's going on in the real world, as opposed to focusing on the business. And, you know, I'm kind of practicing what I'm preaching, right? I've been trying to put things together where people are talking about healthcare and homeschooling and different discussion points that are just have a high level of validity to everybody. Everybody's thinking about it. So providing that type of information, and to their point, as opposed to trying to sell a product in a time like this. And we just want to create that value. I would advise the realtors to stay more in touch with their loan officer and referral partners that they do business with, speak to other people. You know, there's some great minds on the call, and there's a lot of people out there in the industry that can provide a helpful insight. To that same point, some of these deals that you're trying to hold together, one institution may shy away from, one may actually look at. So there's a different level of synergy that we can all develop, being people first, as I've said, and we've all said, but using everybody as a resource, right? We're here to help. We're here to answer questions. We're trying different types of unique ways of staying in front of people, which I would advise all the real estate community to do, just to show value through all of this. If you can show value in any relationship you have, people are always going to want to use you as a resource, right? So just show value and be a person first. Help your neighbor. You see someone need a hand. Is there an elderly person down the block? Do they need me to go pick up groceries? That should be more important than, I know that's not the purpose of the call, and we all know this. I'm not saying anything that anybody doesn't feel, but do that first and foremost. And then rely on the people that you know within the industry, contact them, see if there's any way that they can bring more value to you and your referral partners. And there are ways, guys, on the work level. Sharpen the knife. Read a book. Watch some videos. Read the blogs. Look at podcasts. We're in sales. All too often, people just don't focus that they're salespeople and that there's certain things that could help them be better at their trade. So when I have extra downtime, I like to take it as a more intensive approach to how to build myself for when that eventuality is going to come, right? Where I'm re-released back into the real world, for lack of a better way to put it. And I'm sorry, my dog just got someone let her in and she's going nuts under me right now. But
right?
yeah, but just overall, listen, be a better person, be there for the people around you, family, friends, colleagues, so forth. Try to show additional value. And we're here to help. We're all working. We're working probably more than we ever have. Nights and weekends, it all seems to be blending into one. What day is it today? Is it Thursday? Right? No. So we're all going through the same stuff, guys. But I appreciate you bringing me on, Amanda. Guys, I don't know if we've ever had the opportunity to meet in person, but pleasure hearing a lot of the insight you guys had as well. Absolutely. I appreciate being here. Thank you.
Likewise. Thank you, Amanda.
Thank you guys for coming. And James, you said it perfect, right? Just being a resource is what we all are trying to be, and what you all as real estate agents should be. You've all been leaders. Just being those servant leaders, even more now, it is so much more helpful. And it just speaks to my love language too. I love to serve and be as a resource in the community. So thank you guys for joining me here. You brought some valuable information that I know a lot of people are going to take away from it. If you would do me a favor and just in the comments, just put your information if anybody wants to reach out to you, if they have any particular questions, any videos or words of advice you want to share, feel free to do so. Your time is so valuable today, and I really appreciate you spending it with us. And I'm so happy to see all your families and teams safe and happy and healthy. So thank you guys, and I will see you again soon, okay?
Thank you, Amanda.
Thanks, guys. Thanks, Amanda. You guys have a great day.
Amanda.
See ya.
Good day, boys.
Good, guys.